Welcome back to the channel. Today, we're exploring a topic that is fundamental to building and maintaining wealth: the 12 assets that can make you rich. Understanding and investing in the right assets can be the difference between financial security and financial freedom. In this video, we'll break down 12 key asset classes, ranging from traditional investments like real estate and stocks to more modern options like cryptocurrencies and peer-to-peer lending. Each of these assets has the potential to grow your wealth, and we'll explore how you can incorporate them into your financial strategy. Whether you're just starting on your wealth-building journey or looking to diversify your portfolio, this video will provide valuable insights to help you achieve your financial goals. So, let's dive in. Asset 1. Real estate. Real estate is one of the most powerful and time-tested assets for building wealth. The appeal of real estate lies in its ability to generate multiple streams of income while also appreciating in value over time. When you invest in real estate, you have several options: residential properties, commercial properties, or land, each with its own set of opportunities and risks. Residential real estate involves purchasing homes or apartments to rent out. This can provide a steady stream of rental income, which can cover your mortgage payments and other expenses, eventually leading to positive cash flow. Over time, as you pay down your mortgage and the property's value appreciates, you build equity. This equity can be tapped into for future investments or sold for a profit. Commercial real estate, which includes office buildings, retail spaces, and industrial properties, often offers higher returns than residential properties, but also comes with higher risks. Commercial leases tend to be longer, providing more stability, but finding tenants can be more challenging, and vacancies can be costly. Investing in land offers another avenue, particularly for those with a long-term investment horizon. Land can appreciate significantly, especially if it's located in a rapidly developing area. However, land does not generate income until developed or sold. One of the key benefits of real estate is the ability to leverage other people's money through mortgages. By putting down a small percentage of the property's value, you can control a much larger asset and amplify your returns. Additionally, real estate provides tax advantages, such as deductions for mortgage interest, property taxes, and depreciation, which can significantly reduce your taxable income. However, real estate investment also comes with challenges. It requires significant upfront capital, ongoing maintenance, and management, and it's not as liquid as other investments. The real estate market can also be volatile, and economic downturns can impact property values and rental income. But with careful planning, research, and a long-term perspective, real estate can be a cornerstone of your wealth-building strategy. Asset 2. Stocks. Stocks represent ownership in a company, and they have historically been one of the most accessible and lucrative assets for building wealth. When you buy a stock, you become a part owner of the company, entitled to a share of its profits, which may be paid out as dividends or reinvested to fuel the company's growth. Investing in stocks can take many forms. You can purchase individual stocks of companies you believe will perform well, invest in index funds that track the overall market or sectors of it, or choose exchange-traded funds, ETFs, that offer a diversified portfolio of stocks. Each approach has its own risk and reward profile. Individual stocks offer the potential for high returns, especially if you invest in a company that experiences significant growth. However, they also carry higher risks, as the performance of any single company can be unpredictable. This is where diversification becomes important. By spreading your investments across multiple companies or sectors, you can reduce your risk. Index funds and ETFs provide an easier way to achieve diversification. By investing in these, you're essentially betting on the overall market's performance or specific sectors rather than individual companies. Historically, the stock market has provided strong returns over the long term, making it an effective vehicle for growing wealth. One of the key advantages of investing in stocks is the potential for compounding returns. By reinvesting your dividends and holding your stocks over the long term, you can significantly increase your investment's value. This is why stocks are often recommended for younger investors who have time to ride out market volatility. However, the stock market is not without risks. Market volatility can lead to significant fluctuations in the value of your investments, particularly in the short term. Economic downturns, political instability, and changes in interest rates can all impact stock prices. It's essential to stay informed and maintain a long-term perspective avoiding the temptation to panic sell during market downturns. Overall, stocks should play a significant role in any wealth-building strategy. Whether you're investing for retirement, a major purchase, or simply to grow your wealth, a well-diversified stock portfolio can provide substantial returns and help you achieve your financial goals. Asset 3. Bonds. Bonds are a more conservative asset compared to stocks, offering a lower risk way to generate steady income. When you purchase a bond, you're essentially lending money to a government, municipality, or corporation in exchange for regular interest payments over a fixed period. At the end of that period, the issuer of the bond returns the principal amount to you. There are several types of bonds, each with different risk and return profiles. Government bonds, such as U.S. Treasury bonds, are considered the safest, as they are backed by the government's ability to raise taxes and print money. Because of this security, they generally offer lower returns compared to other types of bonds. Municipal bonds are issued by states, cities, or other local governments to fund public projects. They offer tax advantages, as the interest earned is often exempt from federal, and sometimes state and local, taxes. This makes them particularly attractive to investors in higher tax brackets. Corporate bonds, issued by companies to raise capital, typically offer higher interest rates than government bonds, reflecting the higher risk associated with them. The financial health of the issuing company is crucial when investing in corporate bonds. If the company fails, you might lose part or all of your investment. One of the main advantages of bonds is the predictability of returns. Bondholders receive regular interest payments, known as coupon payments, which can provide a steady income stream. This makes bonds especially appealing to investors seeking income or looking to preserve capital in a low-risk environment. However, bonds are not without risks. Inflation is a significant risk for bondholders, as rising prices can erode the purchasing power of the fixed interest payments. Additionally, if interest rates rise, the value of existing bonds typically falls, as newer bonds offer higher rates. This is known as interest rate risk. Despite these risks, bonds play a vital role in a diversified investment portfolio. They provide stability and reduce overall portfolio volatility, particularly during economic downturns when stocks might be underperforming. For investors nearing retirement or those with a lower risk tolerance, bonds offer a way to safeguard capital while still earning returns. Incorporating bonds into your wealth-building strategy can help balance the higher risks associated with stocks and other volatile assets. By carefully selecting bonds that align with your financial goals and risk tolerance, you can create a more resilient portfolio that withstands market fluctuations while providing steady income. Asset 4. Mutual funds. Mutual funds are an investment vehicle that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Managed by professional portfolio managers, mutual funds offer a way to achieve broad market exposure without the need for individual stock selection or constant portfolio monitoring. One of the primary advantages of mutual funds is diversification. By investing in a mutual fund, you gain exposure to a wide array of assets, reducing the risk associated with any single investment. This diversification is especially beneficial for investors who lack the time or expertise to build and manage a diversified portfolio themselves. Mutual funds come in various types, each designed to meet different investment objectives. Equity funds, for example, focus on stocks and are aimed at capital growth. Bond funds, on the other hand, invest in bonds and are typically used for income generation and capital preservation. There are also balanced funds, which combine stocks and bonds to offer a mix of growth and income, and sector-specific funds that focus on particular industries or regions. Investing in mutual funds is relatively simple and accessible. Most funds have low minimum investment requirements, making them available to a wide range of investors. Additionally, mutual funds are liquid, meaning you can buy or sell shares at the fund's net asset value, NAV, at the end of each trading day. This liquidity provides flexibility, allowing you to adjust your investments as your financial situation or market conditions change. Professional management is another significant benefit of mutual funds. Fund managers make decisions about which securities to buy or sell based on extensive research and analysis, potentially increasing the fund's performance. However, this professional management comes with fees, known as the expense ratio, which can vary significantly between funds. It's essential to consider these fees when selecting a mutual fund, as they can impact your overall returns. While mutual funds offer many advantages, they also come with risks. Like any investment in the financial markets, mutual funds can lose value, particularly in a market downturn. The degree of risk depends on the types of securities the fund holds. Equity funds, for instance, tend to be more volatile than bond funds. Additionally, mutual funds do not provide the same control over individual investments as owning stocks or bonds directly. Despite these risks, mutual funds remain a popular choice for building wealth due to their diversification, professional management, and ease of access. They are particularly suited for investors looking to achieve specific financial goals, such as retirement savings, education funding, or simply growing their wealth over time. By selecting mutual funds that align with your investment objectives and risk tolerance, you can build a diversified portfolio that helps you achieve your financial goals while managing risk effectively. Asset 5. ETFs, Exchange-Traded Funds. Exchange-Traded Funds, or ETFs, have gained significant popularity as an investment vehicle due to their flexibility, liquidity, and cost-effectiveness. An ETF is similar to a mutual fund in that it holds a diversified portfolio of assets. But unlike mutual funds, ETFs are traded on stock exchanges, meaning they can be bought and sold throughout the trading day at market prices. One of the key advantages of ETFs is their low cost. Because many ETFs are passively managed, tracking a specific index rather than trying to outperform the market, they typically have lower expense ratios compared to actively managed mutual funds. This makes ETFs an attractive option for cost-conscious investors looking to minimize fees and maximize returns. ETFs offer a wide range of investment options, from broad market indices like the S&P 500 to specific sectors, regions, or asset classes. This diversity allows investors to tailor their portfolios to their specific investment goals and risk tolerance. For example, you can invest in an ETF that focuses on technology stocks, emerging markets, or bonds, depending on your strategy. Another significant benefit of ETFs is their liquidity. Because ETFs are traded on exchanges, you can buy and sell shares throughout the trading day at market prices, just like individual stocks. This intraday trading capability provides flexibility and allows investors to respond quickly to market changes. Additionally, ETFs are typically more tax efficient than mutual funds, as they generally incur fewer capital gains taxes due to their unique structure. However, ETFs are not without risks. The value of an ETF can fluctuate throughout the trading day, and because they track specific indices or sectors, they are subject to market volatility. Additionally, while ETFs offer diversification, they do not eliminate risk entirely. It's also important to be aware of trading costs. Frequent trading of ETFs can lead to higher transaction fees, which can erode your returns. Despite these risks, ETFs are an excellent tool for building a diversified investment portfolio. Their low costs, flexibility, and wide range of investment options make them suitable for both beginner and experienced investors. Whether you're looking to build a long-term retirement portfolio, generate income, or capitalize on specific market trends, ETFs can help you achieve your financial goals while managing risk effectively. Asset 6. Cryptocurrencies. Cryptocurrencies have emerged as one of the most exciting and potentially lucrative assets in recent years. As digital or virtual currencies that use cryptography for security, cryptocurrencies offer a decentralized alternative to traditional financial systems, with the potential for significant returns. The most well-known cryptocurrency is Bitcoin, but there are thousands of others, including Ethereum, Litecoin, and Ripple, each with its own unique features and use cases. One of the main attractions of cryptocurrencies is their potential for high returns. Over the past decade, Bitcoin and other major cryptocurrencies have seen exponential growth, making early investors substantial profits. This rapid appreciation in value has led many to view cryptocurrencies as a way to build wealth quickly, though it's important to note that these markets are highly volatile and can experience significant price swings. Another advantage of cryptocurrencies is their decentralization. Unlike traditional currencies, which are controlled by governments and central banks, cryptocurrencies operate on decentralized networks based on blockchain technology. This means that transactions can be made directly between users without the need for intermediaries, potentially reducing costs and increasing transaction speed. Additionally, cryptocurrencies are often seen as a hedge against inflation and currency devaluation, particularly in regions with unstable economies. Investing in cryptocurrencies can be done in several ways. You can buy and hold coins directly through cryptocurrency exchanges, trade them for short-term gains, or invest in blockchain technology through companies or ETFs that focus on the cryptocurrency industry. Each approach has its own risk and reward profile, and it's important to do thorough research before diving into the market. However, cryptocurrencies also come with significant risks. The market is still relatively new and unregulated, which can lead to high volatility and the potential for fraud. The lack of regulation also means that investors have less protection compared to traditional financial markets. Additionally, the value of cryptocurrencies can be heavily influenced by market sentiment, news, and government regulations, leading to sudden and dramatic price changes. Security is another concern when investing in cryptocurrencies. Because they are digital assets, cryptocurrencies are vulnerable to hacking and theft. It's crucial to store your coins in secure wallets and use reputable exchanges to mitigate these risks. Despite these challenges, cryptocurrencies have become an increasingly popular asset class for wealth building. For those willing to take on the associated risks, they offer the potential for high returns and the opportunity to participate in a rapidly evolving financial landscape. As with any investment, it's important to diversify your portfolio and not invest more than you can afford to lose. By carefully considering the risks and rewards, cryptocurrencies can play a valuable role in your overall wealth-building strategy. Asset 7. Commodities. Commodities are tangible assets that include resources like gold, silver, oil, natural gas, and agricultural products such as wheat, corn, and coffee. Investing in commodities offers a way to diversify your portfolio, hedge against inflation, and gain exposure to different markets that may not correlate directly with traditional financial assets like stocks and bonds. One of the primary reasons investors turn to commodities is their ability to act as a hedge against inflation. When inflation rises, the value of currency typically decreases, leading to higher prices for goods and services. Commodities, on the other hand, tend to increase in value during inflationary periods, as their prices are directly linked to the cost of raw materials. This makes commodities an attractive option for preserving purchasing power in times of economic uncertainty. There are several ways to invest in commodities. You can purchase the physical assets directly, such as buying gold bars or silver coins. However, storing and securing physical commodities can be challenging and costly. Alternatively, you can invest in commodity futures contracts, which are agreements to buy or sell a specific quantity of a commodity at a predetermined price on a future date. Futures contracts allow you to speculate on the price movements of commodities without having to take physical possession of the asset. Another popular way to invest in commodities is through ETFs that track specific commodities or a basket of commodities. These ETFs provide a convenient way to gain exposure to commodity markets without the complexities of trading futures contracts. Additionally, you can invest in companies that produce or process commodities, such as mining companies or agricultural firms. This approach allows you to benefit from commodity price movements indirectly through the performance of the underlying companies. Commodities can be volatile and are often influenced by a wide range of factors, including geopolitical events, weather conditions, and changes in supply and demand. For example, oil prices can be affected by tensions in the Middle East, while agricultural commodities might be impacted by droughts or floods. This volatility can present both opportunities and risks for investors. It's also important to note that commodities do not generate income like stocks or bonds. Their value is entirely based on price appreciation, which means that your returns are dependent on the timing of your investments. Holding commodities during a period of declining prices can result in significant losses. Despite these risks, commodities can be a valuable addition to a diversified investment portfolio. They offer protection against inflation, provide exposure to different economic sectors, and can enhance returns when traditional assets are underperforming. As with any investment, it's essential to understand the specific dynamics of the commodity markets you're investing in and to use them as part of a broader, diversified investment strategy. Asset 8. Intellectual property. Intellectual property, IP, is an often overlooked asset class that can generate significant wealth, particularly for those with creative talents or innovative ideas. IP refers to creations of the mind, such as inventions, literary and artistic works, designs, symbols, names, and images used in commerce. By securing intellectual property rights, individuals and businesses can protect and monetize their creations, turning ideas into valuable assets. There are several types of intellectual property, each with its own legal protections and potential for wealth generation. Patents protect inventions and grant the patent holder the exclusive right to make, use, or sell the invention for a specific period. Trademarks protect brand names, logos, and slogans, helping businesses build and maintain brand recognition. Copyrights protect original works of authorship, such as books, music, films, and software, ensuring creators can control and profit from their creations. Trade secrets protect confidential business information, such as formulas, processes, or customer lists, from being disclosed or used by competitors. One of the key advantages of intellectual property is its ability to generate passive income. Once IP rights are secured, the owner can license or sell the rights to others in exchange for royalties or a lump sum payment. For example, a musician can license their songs for use in films, commercials, or streaming platforms, earning royalties each time the song is used. Similarly, an inventor can license their patent to a company that manufactures and sells the product, receiving a percentage of the sales. Intellectual property can also increase the value of a business. Strong brands, innovative products, and proprietary technologies can give companies a competitive edge, attract customers, and enhance profitability. In many cases, the value of a company's intellectual property far exceeds the value of its physical assets, making it a critical component of the business's overall worth. However, intellectual property also comes with challenges. Securing IP rights can be a complex and costly process, requiring legal expertise and significant financial investment. Additionally, enforcing IP rights can be difficult, particularly in cases of infringement or unauthorized use. It's essential to work with legal professionals who specialize in intellectual property law to navigate these challenges effectively. For individuals and businesses with creative or innovative capabilities, intellectual property offers a unique opportunity to build wealth. By developing, protecting, and monetizing IP assets, you can create a sustainable income stream and increase the overall value of your portfolio. Whether you're an entrepreneur, artist, or inventor, intellectual property can play a vital role in your wealth-building strategy. Asset 9. Private equity. Private equity refers to investments made in private companies or in public companies with the intention of taking them private. Unlike stocks, which are traded on public exchanges, private equity investments involve direct ownership stakes in companies that are not publicly listed. This asset class is typically accessible to institutional investors and high-net-worth individuals due to the large amounts of capital required and the long-term nature of the investments. One of the main attractions of private equity is the potential for high returns. Private equity firms typically target companies that they believe have significant growth potential, but may be undervalued or underperforming. By providing capital, strategic guidance, and operational expertise, private equity investors aim to improve the company's performance and increase its value over time. Once the company reaches a certain level of success, the private equity firm may exit the investment through a sale, merger, or initial public offering, IPO, generating substantial returns for investors. Private equity investments can take several forms, including venture capital, growth capital, buyouts, and distressed investments. Venture capital involves investing in early-stage companies with high growth potential, often in the technology or biotech sectors. Growth capital is provided to more established companies looking to expand or enter new markets. Buyouts involve acquiring a controlling interest in a company, often with the use of leverage, to improve its operations and profitability. Distressed investments target companies in financial difficulty with the goal of turning them around. While private equity offers the potential for high returns, it also comes with significant risks. These investments are typically illiquid, meaning they cannot be easily sold or traded, and they often require a long-term commitment of several years. The success of a private equity investment depends heavily on the management team's ability to execute the business plan and improve the company's performance. Additionally, private equity investments are often concentrated in a few companies, which increases the risk if one or more of those companies underperforms. Private equity can also be challenging to access for individual investors due to high minimum investment requirements and the need for specialized knowledge. However, some investors can gain exposure to private equity through funds that pool capital from multiple investors to invest in a diversified portfolio of private companies. Despite these challenges, private equity remains an attractive option for those looking to diversify their portfolios and achieve high returns. By carefully selecting private equity investments and working with experienced managers, investors can potentially benefit from the growth and value creation in private companies. As with any investment, it's important to thoroughly understand the risks and ensure that private equity fits within your overall investment strategy. Asset 10. Fine art and collectibles. Fine art and collectibles have long been considered prestigious assets, often associated with wealth and status. Beyond their aesthetic appeal, these tangible assets can also serve as lucrative investments, offering the potential for significant appreciation over time. Whether it's a painting by a renowned artist, a rare antique, or a limited edition collectible, investing in art and collectibles can diversify your portfolio and provide unique opportunities for wealth generation. One of the key attractions of fine art and collectibles is their potential for long-term appreciation. The value of art, in particular, has a history of increasing over time, especially for works by established and emerging artists. High-profile auctions have seen record-breaking sales, with masterpieces fetching millions of dollars. Similarly, collectibles such as rare coins, stamps, vintage cars, and memorabilia have shown strong price appreciation, driven by demand from collectors and investors alike. Investing in fine art and collectibles also offers a way to diversify your portfolio beyond traditional financial assets. These tangible assets often have a low correlation with the stock market, meaning their value may rise even when other investments are underperforming. This diversification can help reduce risk and enhance overall portfolio performance. Additionally, art and collectibles can provide personal satisfaction and cultural enrichment, as they can be displayed and enjoyed while they appreciate in value. However, investing in fine art and collectibles comes with its own set of challenges. The market for these assets can be highly illiquid, meaning it may be difficult to sell quickly or at the desired price. The value of art and collectibles is also highly subjective and can fluctuate based on trends, tastes, and the reputation of the artist or creator. Moreover, the costs associated with buying, selling, and maintaining these assets can be significant, including auction fees, insurance, storage, and restoration expenses. To successfully invest in fine art and collectibles, it's crucial to have a deep understanding of the market and to work with reputable dealers, galleries, and auction houses. Provenance, or the history of ownership, is a critical factor in determining the value of a piece, so ensuring that the asset is authentic and has a clear and credible history is essential. Additionally, it's important to consider the long-term potential of the investment, as art and collectibles may take years, if not decades, to reach their full value. Investors can also consider alternative ways to gain exposure to the art market, such as art investment funds, which pool capital to invest in a diversified portfolio of artworks. These funds offer a more accessible way to participate in the art market without needing to purchase individual pieces. Despite the challenges, fine art and collectibles can be a rewarding and profitable investment for those who approach the market with knowledge and patience. By carefully selecting pieces with strong potential for appreciation and working with experts, investors can build a valuable collection that enhances their wealth while also providing cultural and aesthetic enjoyment. Asset 11. Real Estate Investment Trusts (REITs). Real estate investment trusts, or REITs, offer an accessible way to invest in real estate without the need to purchase, manage, or finance properties directly. REITs are companies that own, operate, or finance income-producing real estate across a variety of sectors, including residential, commercial, industrial, and retail properties. By investing in a REIT, you can gain exposure to the real estate market and enjoy the potential for steady income and capital appreciation. One of the primary benefits of investing in REITs is the ability to earn regular income through dividends. REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends, making them an attractive option for income-seeking investors. These dividends are typically higher than those offered by traditional stocks, as they are derived from the rental income generated by the properties owned by the REIT. REITs also provide diversification within the real estate sector. Because REITs own and manage a portfolio of properties across different sectors and geographic regions, they offer a level of diversification that would be difficult to achieve by investing in individual properties. This diversification helps reduce risk and can lead to more stable returns over time. Another advantage of REITs is their liquidity. Unlike direct real estate investments, which can be illiquid and time-consuming to buy and sell, REITs are traded on major stock exchanges, making it easy to buy and sell shares. This liquidity provides investors with the flexibility to adjust their portfolios quickly in response to market conditions. However, like all investments, REITs come with risks. The performance of a REIT is closely tied to the real estate market, which can be affected by factors such as interest rates, economic conditions, and changes in demand for different types of properties. Additionally, while REITs offer diversification within the real estate sector, they may still be subject to sector-specific risks. For example, a REIT that focuses on retail properties may be affected by the decline of brick-and-mortar stores due to the rise of e-commerce. Investing in REITs also involves paying attention to the management team's expertise and the specific properties within the REIT's portfolio. The success of a REIT often depends on the ability of the management team to select and manage properties effectively, as well as their strategy for growth and income generation. For investors looking to gain exposure to real estate without the complexities of direct property ownership, REITs offer a compelling option. They provide the potential for steady income, diversification, and capital appreciation, making them a valuable addition to a well-rounded investment portfolio. As with any investment, it's important to carefully evaluate the specific REITs you're considering and to ensure that they align with your overall investment goals and risk tolerance. Asset 12. Precious metals. Precious metals such as gold, silver, platinum, and palladium have been valued for their rarity, beauty, and utility for thousands of years. As an investment, precious metals offer a hedge against inflation, currency devaluation, and economic uncertainty, making them a popular choice for preserving wealth over the long term. Whether held in physical form, such as bars or coins, or through financial instruments like ETFs, precious metals can play a crucial role in a diversified investment portfolio. One of the key benefits of investing in precious metals is their ability to act as a store of value. Unlike paper currencies, which can be subject to inflation and devaluation, precious metals have intrinsic value that has historically remained stable or increased over time. During periods of economic instability or geopolitical tension, investors often flock to precious metals as a safe haven, driving up their prices. Gold is the most widely recognized and traded precious metal, known for its role as a hedge against inflation and currency fluctuations. Silver, while less expensive, is also a popular investment, particularly because it has both industrial and monetary uses. Platinum and palladium are less commonly held as investments, but are highly valued in the automotive and industrial sectors, where they are used in catalytic converters and other applications. Investors can gain exposure to precious metals in several ways. Physical ownership, such as buying gold bars or silver coins, offers the security of holding a tangible asset, though it requires storage and insurance. Alternatively, investors can purchase shares in precious metal ETFs, which provide exposure to the price movements of these metals without the need for physical storage. Additionally, investing in mining companies or mutual funds that focus on precious metals offers indirect exposure to this asset class. While precious metals offer stability and protection against inflation, they are not without risks. The prices of these metals can be volatile, influenced by factors such as interest rates, currency strength, and changes in industrial demand. Additionally, precious metals do not generate income, so their value depends entirely on price appreciation. Holding a large portion of your portfolio in precious metals can also lead to missed opportunities in other asset classes that offer higher growth potential. Despite these risks, precious metals remain a valuable component of a diversified investment strategy. By including gold, silver, or other precious metals in your portfolio, you can protect your wealth against inflation and economic uncertainty while benefiting from the long-term appreciation of these enduring assets. As with any investment, it's important to consider your overall financial goals and risk tolerance when deciding how much of your portfolio to allocate to precious metals. And there you have it, 12 powerful assets that can help you build lasting wealth. From traditional investments like real estate and stocks to more unconventional options like cryptocurrencies and collectibles, each asset offers unique opportunities to grow your financial portfolio. The key to success is diversification. By spreading your investments across different asset classes, you can reduce risk and increase your chances of achieving financial independence. Remember, wealth building is a long-term journey that requires patience, knowledge, and strategic planning. Start by focusing on the assets that align with your financial goals and risk tolerance, and gradually expand your portfolio as you gain experience. If you found this video helpful, don't forget to like, share, and subscribe for more tips on building wealth and achieving financial freedom. Thanks for watching, and until next time, keep investing in your future.